Good afternoon. This is Peter Quinn. I'm with Kidder Matthews here in San Diego, California. I have with me today a dear old friend who's been a real stalwart in the lending community over the years. And I'd like to tell you a little bit about her. So she is obviously an industry leader. She's an author, a keynote speaker to many groups all across the country on commercial real estate issues. She's an influential board member, and she's a grandma to six beautiful little kids, I guess. They're probably not little anymore, are they?
They're not.
So please welcome Ann Hambly, founder and CEO of First Service Solutions. First Service Solutions is an advocate in an area of lending that not a lot of people pay attention to, and that's the commercial mortgage-backed security business, or CMBS. In times of rising inflation and uncertainty in the financial marketplaces, sometimes a lot of scrutiny is spent on the CMBS marketplaces because there's not a single lender who's sort of in charge of that debt. It's combined under a mortgage-backed security offering and sold into the financial markets. I'm not going to try to tell you what Ann does, though, because I'm not qualified. So let's begin. Ann, welcome. Great to see you.
Thank you. And I really appreciate you including me, Peter.
My pleasure. Is there anything else that we can talk about First Service Solutions before we get into a little Q&A?
Well, I think really you hit the nail on the head and summarized it, but really what we do is serve as an advocate or an advisor to commercial real estate owners on CMBS debt. And the reason I focus on CMBS debt is exactly what you articulated earlier, is that there's not one person you can talk to. So it's a series of people all abiding by different rules that an owner doesn't have access to. So really what I do is I demystify CMBS, make it a little more friendly. It's kind of hard to do that, but make it a little more palatable and help people owners get from where they are to wherever they want to go, whether they need to assume a debt or modify their debt or whatever. I help them through the whole process.
We worked together on a company that I attempted to start several years ago, and I recalled the difficulty in navigating that divide, because it's really not a bridge between the special servicer and the borrower. Sometimes it is a moat, and there's just no way as the individual borrower to get across that moat. Because I found that your relationships with the special servicers who were most active in that time frame was absolutely key to getting an audience. And if you can't get an audience, you can't solve the problem.
Yeah, well, I always say, knowing the people is absolutely critical. But most importantly, and this is where our firm really adds value, is you have to know the rules that they're abiding by, right? I always say, like in any kind of, if I sat down at a blackjack table in Vegas and I didn't know I was playing blackjack and I tried to play poker or something, I'm probably going to get wiped out, right? I don't know if that's a good analogy, but point is, owners inadvertently, they get a loan and it gets sold off, like you said, and all of a sudden now they have a CMBS loan and they inadvertently think they can call up their originator at Wells Fargo Bank and get everything done they need to get done. And they quickly find out it doesn't work like that at all. So you not only have to know the people and who to call, but you most importantly have to know the rules. And it doesn't do any good to argue with them about the rules they have to follow, because they do. It is the rules are the rules, so you have to know them. So anyway, I think that's the key.
And it was interesting to me during that time when we were spending quite a bit of time together that the most sophisticated developers in the country did not know how to navigate this process. They could have developed 25 commercial retail centers in really good markets across the country, and they wound up with one deal that wound up being in technical default. That is not, they didn't miss a payment, but they lost a tenant. And in cases like that, the special servicer or the master servicer can declare the loan in default. And now begins the process, which you have been so helpful in helping people navigate. So let's get into some questions about what's going on in the marketplace today.
Got it.
So we've got, obviously, in a time in our lives now, another time in our lives, we have rising interest rates. We have coincidentally rising labor rates, which don't always follow rising interest rates, rising inflation. We have rising utility rates and diminishing utility resources, which are really going to impact Americans all over the country this summer. So how does this movie end?
Oh, I think the question is not how does it end, but when does it end, if it ever does, right? I watched, so when COVID hit, I know this isn't directly related to COVID at all, but when COVID hit in 2020, I think every commercial real estate owner that had a hotel was calling me, asking me to help them get relief on their, for COVID. So we did that. And I'm finding, those poor hospitality deals have just now started to recover. And now they're dealing with, all the other factors that you just mentioned and everything going on. So I don't think this is a movie. I loved your question. How does a movie end? I don't know that it's one movie, but I think it's going to have a whole bunch of sequels. And I don't know how many. And, I think the only thing we know is that there will be change in the market, which we'll talk about a little more, I think, today. And CMBS is anti-change. I mean, the only way CMBS works is if everything is static and stays the same for the term of the deal, right? So there's a lot of stuff changing. Yeah.
Because the rules are written into that document.
Right.
Follow the rules.
Right. Absolutely.
Understand. So are you anticipating growing defaults in commercial real estate?
Absolutely.
22 and 23?
Absolutely. You have to, when I answer that question, now there's plenty of people, let's say you're in the industrial segment of the business or even multifamily, you'd think I'm nuts, right? But I look at, like, let's take a mall, right? I mean, there's a lot of stuff going on in malls, but let's say you take a mall and it's maturing in 2023. That means the loan was originated in 2013. Likely value is not the same, right, today as it was in 2013. And more importantly, how do you refinance that and make another 10-year loan? How are malls going to look in 2033, right? I mean, I think, again, there's a lot of changes, and the change will mean defaults for CMBS, because the only way, as you kind of alluded to earlier, to get anything done is by a special servicer, which by itself means the loan has to kind of go into default. So whether it's the recession or not, and I don't know how big the recession will be or how long, or, I don't think anybody does, putting that even aside, you've got property types that are definitely changing. So I think there will be, yes, increasing defaults for sure.
Interesting set of events that are occurring all around the country is Amazon has announced that they're now going to be pulling back. Their chief architect of the real estate acquisition and leasing is leaving the company. And here locally, a brand new 300,000 square foot building is being ready for Amazon, and they decided that they're not going to occupy. Single tenant, institutional quality. And I look at that and go, boy, I hope they don't have a CMBS loan on that, because by losing the tenant, by them not occupying,
right,
they'd be in default.
Yeah. Well, and so here I thought there was one secure property type that we could ignore, and that was industrial, because it's been so good. But yeah, that's an example. One, I don't think we used to be so dependent on, one tenant or one way we shop or retail or all of us humans being in an office together and working together. Now there's everything that we knew, Peter, you and I've been, everything we knew 25 years ago is just all suspect to change right now, right? It's amazing.
Exactly. Yeah, the rules are changing, and we got to pay attention, because it's going to affect how we use real estate and the investment value of that real estate. So that takes us to a great next question: is what sectors will be most heavily impacted by the coming recession and rising interest rates and pressure.
Right. I really think it's two property types. Really, one is, okay, I kind of already talked about malls, but let's take retail, right? There is no question, I don't know that anybody would believe that retail's not going to change a lot over the next 10 years. And the reason I keep using 10 years is because that's the average term of a CMBS loan. That's what investors want when they invest in this. So it's not going to look the same. So by nature of the fact that it's not going to look the same means that that was my phone. I apologize. I'm turning it off right now.
Yeah, I was just looking at mine.
I know. And I realized, gosh, nothing worse.
No
But
worries.
there are going to be changes, and changes mean that a servicer is going to have to get involved, a special servicer, which means there will be bigger default rates, right? So retail for sure. You almost have to break it up into subgroups then, though, because I'm seeing a major difference between malls in retail and how they are performing versus strip centers. You know, they're kind of not being hit as hard as some of the big malls. And then you take office, and this is to me always the really unknown. And I think the one thing we know for sure with office is it's changing, right? The dynamics of how we work, and do we work a little at home or not? You know, I think the change by itself is going to require that almost every major tenant, when their lease renews the next year, they're going to have to relook at it, right? They'd probably not be doing their job if they didn't look at it and wonder if they could reduce their space, reduce their rent, demand more. It's just kind of where the market is going. So I see retail and office as the two big upcoming property types that are going to have a big change. I hate to call it default because it may not be a true, missed payment, but it's going to take some restructure of that kind of debt. Yeah.
One of the experts in that mall business is someone who's in a national networking group that I'm involved with, and he focuses on malls. He thinks that there are 1,300 open and closed malls around the country, of which a little over 300 are viable. That's amazing.
Yeah,
I mean,
scary. Yeah,
we have a couple here in San Diego that are suffering, but they're trying to pivot towards tearing down that Macy's and Nordstrom and putting up 1,000 apartments.
right.
That may be the way to keep the remaining retailers alive, but boy, that's a dramatic difference in how that property was
Right.
thought to be used.
And now let me add something. So let's say so this is a classic example of the difference between CMBS and on book bank stuff. So if that mall, who knows that its most viable future will occur if it changes part of the space to multifamily, right? If they had a bank loan and the banker agreed with them, they could do that. In CMBS, you cannot change the fundamental, reason, or what am I trying to say, that if it's a mall, you can't make it part multifamily. It just doesn't. You can't do that. So CMBS is just so restrictive in what you can and can't do. That's what's going to cause a lot of this issue.
Wow.
I know.
Those are really things to keep an eye on.
Absolutely.
So who is over leveraged today?
Well, probably those same two property types. When you look at 08, I just want to kind of contrast it, but in 08, which you and I worked together through some of that downturn, the issue there was leverage, right? If you just took the debt off those properties and put a reasonable debt size on it, all worked. So it was just too much debt. That's not the fundamental problem right now. COVID, of course, was a temporary problem. We all kind of got hit by that, but the upcoming issues and this next couple years is a combination, I think, of the recession, whether it's big, small, whatever. I mean, every sign is out there, right? And the necessary change to retail, like you just talked about. You have to do something, and you can't do that very well in CMBS, and also office. Office will have those changes. So I forgot what you originally asked me.
That was, I think you answered it.
Yeah.
What are the sectors that are going to be most heavily impacted?
Yeah.
And retail at the mall and power center level are going to be impacted. And the strength in the neighborhood shopping center marketplace is enormous at the moment. Investment groups are buying up every market drug center they can find in markets that are otherwise strong. I haven't really looked at some of the tertiary markets, but certainly the appetite's been there for things that everybody still needs.
Yeah.
Even though milk and eggs are a lot more expensive today than they were.
But that's for sure. But you know, here you mentioned before I got on this call with you and heard you mention what you heard about Amazon and there, and I had kind of heard a little bit about that, but I hadn't focused on it too much. So here we are thinking, you know, what property types are going to be most affected by what's going on in the market. All it takes is one big decision like Amazon to change the dynamics today, right? What if they decided to do something different and do everything through a drone and they don't need as many, you know, supply centers? I don't, here we were thinking about office space and how there's a lot of people working hybrid and all that. And then I heard, I can't remember who made the announcement. It was not Bezos, but it was, I think it was Elon Musk. Somebody said, you're going to have to come in the office if you want to work for me, and you have to work 40 hours a week with your butt in the chair, right?
Right.
Okay, well, that could change our whole office market too, then, in a good way. But it's funny how one thing, you know, in this day and age, one thing like that, one business changing can, or a virus that comes around can have such a disruption on our entire marketplace, commercial real estate specifically, you know?
It's been a moving target. My son, my oldest, is investment banker with Deutsche Bank, and they, along with a lot of other big investment banks, said, you know, we want you in, you know, those seats on January 1, 22. And then it was, well, we'd like you in those seats 3 days a week in February 2022. And now it's, you know, could you come in once a week?
Oh, yeah. And then is he in New York?
Started in January of 23.
Yeah. And if he's in New York, then you have to factor in, like, how do you get there safely, right? I mean, so there's so many things. Yeah, so much.
Where you go to lunch, because of the 25,000 restaurants, about a half of them are gone in New York City today. And I don't know that that's the right number, but I know that there's an enormous number of retail establishments that have not been able to reopen their doors.
Yeah.
It's really unbelievable.
It is unbelievable.
What options should a commercial borrower consider, given the circumstances which are? Great
question. I had a call. I'm sorry, I interrupted your question.
No, you're good.
I had a call earlier today, and I won't, of course, nobody will know, so I'm not going to say who it was, but big mall owner, and their plan is to, and this is what they're doing, they put all their, well, not all, but they put a chunk of their retail out on the market, hired a broker's out there actively negotiating for a sale, right? And I asked them, we talked about how I could help, right? And they said, well, I don't think we really need help, because once a buyer comes in, they assume and we move on. And I said, do you know if always that retail will sell for the debt amount that or greater? Well, we're not really sure, right? Might sell for less. Well, then you got to work out and negotiate something with the servicer, right? But I guess where a long answer to your question is, what should a commercial borrower do, is know your options, like way, way, way early in the process. And then we always preach this in 08 too, right? This is not your friendly banker that you can pick up the phone and call one day and work something out. There's a process, a timeline, everything takes a long time. And you want to know where their heads are as a servicing community before you start making your decisions. If you make them go down the road, get to the end result, and then ask, what if it doesn't work? You know? So I think the biggest message is get advice from people who understand this market. Obviously, that's one thing we do, that your firm does that too. We get advice from somebody who knows what the servicers are doing, what the lenders are doing, and approach early. Think of that early on. Don't wait until you list it, find out what it will sell for, and then make the phone call. So I think that's what I would say is the.
Yeah. And you're very generous to say that I might have some of those same capabilities, but when I get faced with that problem, I call you. I'm
Well, I
not going to
meant
try.
non-C, yeah, no, but
So there's going to be opportunity though. There
oh
is
yeah.
always opportunity in marketplaces like this. Where do you see uh, some of those opportunities occurring for investors?
Well, so let's take that mall owner, that retail owner, right? Right now, what's happening in the marketplace, and I really feel so passionate about this. You're seeing this every day. You read about owners handing their properties back to the servicer, right? See, it's non-recourse. I'm kind of done with it. It's upside down. Maybe I break even, but I'm done. So here you go. Here's your baby, right? And so what that means, if you look ahead a couple years, it's possible that in 2 or 3 years, if that trend continues and these large owners take that approach and just hand their property back, you're going to have 5 companies. I mean, I'm looking at the list, maybe 8, but 5 companies owning like a huge chunk of commercial real estate. Can you imagine the control those people will wield? I mean, they can decide what to pay brokers. They can decide I mean, they'll be ruling the whole market, right? So the opportunities exist for, for distressed capital that wants to come in by working early on with those people that want to get out. So you got people who want to get out, allow the private sector capital market to come in and align themselves with the owner and hand it to them, as opposed to letting everything go back to the servicers, right? So there are opportunities. I think it's going to be mostly abundance or mostly retail and office, although that could all change with another announcement from one big firm, but right now I think it's retail and office. And the key is to be aligned with the current owner. And that's really what we do. We facilitate a lot of these off-market transactions. I got an owner who wants to hand the property back, got someone with capital that wants to buy it. Let's make a deal, right? And that servicer would be happy to have that kind of a deal too. Usually there's a false perception in the market that servicers won't work with anybody, and they don't, but that's not true. You can get deals done, but like I said early on, you have to know the rule book, right? And so yeah.
And that deal doesn't happen if the value is less than debt.
Well, it can. That deal can happen if the value is less than debt, but the key is you have to know how to approach the servicer for approval and how to structure it. If there's a lot of term left on the loan, it may be a modification of the existing loan. If there's very little term left, it might be a discounted payoff. Those are happening too, So there are ways to get deals done. Yeah, but you have to align yourself with the current owner. That's the best way to do it in CMBS. And then, that's how make deals work pre-foreclosure in CMBS. I'm sure there's going to be a lot of stuff that's going to get auctioned or listed through a broker after foreclosure at some point, but
right.
You don't want to bid then, so then it's on market.
So this question isn't on our list, but so I'm a buyer. I want to acquire this regional shopping center. I'm friendly with the owner of that regional shopping center, and we agree on a deal. Can I assume that CMBS debt?
Yes. I would say the best thing at that point, when you as a buyer and an owner agree upon a deal and there's existing CMBS debt in place, let's talk. Because yes, there could be an assumption. Absolutely. Yes, there could potentially be discounted payoff and then you get new debt. There could be ways to structure this. My fear with the assumptions are what we're seeing, and so this is going to be a challenge, is the special servicer is basically wanting the buyer to artificially get the loan to value to what it was at origination of the loan. So you take a mall today, appraised at, you got a 60% loan to value deal in 2012. It's maturing today. It represents 100% loan to value, the sale amount, right?
Right.
But the servicer wants now that buyer to put in a big chunk of reserves that you can't touch, that are artificially making the LTV kind of a lower LTV like it was at origination. That kills every deal. So you have to know that up front, and you have to be able to factor those things in and figure out how servicers alternatively will allow a deal like that to get done. So there's a lot of things, to my point about thinking about it early on, there's a lot of things to think about. But yes, to answer your question, short answer, you can do assumptions. Yes.
Interesting. So I think we've probably covered this, but just give me a summary of the services that First Service Solutions provides their clients in the marketplace.
Great. Thank you. Yeah. Well, I like to always say, like, other than giving people a new loan, because I don't do new loans and I'm not a broker, right? So after you've got a CMBS loan as an owner, there's pretty much nothing I can't do post-closing. So if you need, let's say you need a lease approved, okay, we can do little things like that. You need money out of reserve, those everyday annoyances, we do all that. That's nothing, right? We also handle it when there's an assumption. That's what I started the business to do in 2005, is someone else is buying your property, assuming your debt. That can take on a life of its own. So we expedite, facilitate, and let a buyer know what the servicer will likely require, so the deal doesn't fall apart at the end. We've obviously in the 2008 downturn handled tons and tons of restructures, recapitalization of portfolios, anything you need lender consent for. That's really what we do. Had about 700 all-in COVID relief requests in 2020.
Wow.
Yeah, so I look back at the numbers now too, and I felt it, but my whole team felt it, but it was like, wow. Yeah, so we had a lot then. And we're preparing to help owners think through their options in the upcoming recession. So basically anything on a performing loan, non-performing loan, anytime you need advice, help, lender approval, that's what we're here for. The only exception to that is I've started, when owners think to ask me, before you sign new CMBS loan documents, I review them and let them know, like, don't agree to this, or if this word is changed, it'll help you a lot long-term. So we review new loan documents too. So that's really the summary. Let me add one thing. I've had someone say to me, oh, so in summary, you try to take the stress out of CMBS. And I said, yeah, that's a great way to word it. So that's it in a summary. Right.
Do I know as a borrower that my loan is going to go into a commercial mortgage-backed security package?
Not always. I'd say usually you do. Back in the olden days, early on, you didn't always know, but I think most people do know now. So it's not generally a surprise. What I think during COVID, what I realized is what is a surprise is, so you've got a lot of, class A properties with borrowers who've never defaulted a day in their life. I mean, these are premier assets and premier owners, and it didn't matter to them if it was CMBS or not, because they're always going to make their payment, and it's perfect for that. But COVID hit, right? And then they realized, oh man, this is way different. And so I think a lot of people's eyes are open now to ask at origination, is this going to be a CMBS loan? And if so, who is my servicer going to be? And, what's my life going to be like after? So, yeah.
Wow, you are such a fountain of knowledge. It's so great catching up with you.
Peter.
And it's nice to see you.
Yeah.
I don't think I've seen you on video or otherwise for the last 3 years.
Yeah.
So, folks, Ann Hambly is an expert, as you have just seen in the last 25 minutes. I want you to please feel free to reach out to her and her incredible team if you are thinking about getting a loan on a project that would qualify for a CMBS mortgage. And in instances, maybe where you're not sure, be sure, be safe. And thank you so much. Great to see you, and hope we see you in person soon.
Absolutely. Thank you so much, Peter. This is my pleasure.
Take care.
Thanks.